are prepared to break the silence, I'll be out in the sunshine, running beside the lions. I've been feeling down, but I've been looking up.
Hello, welcome back to WINFXTRADING YouTube channel, the only channel that has been optimized to make you rich trading the Forex synthetic market. If this is your first time of visiting my YouTube channel, do your best to subscribe and turn on the bell notification so that you get notified each time I upload a new content. Try to like and refer this channel to your network so that YouTube will push us to a very high level of audience. So in today's topic, we shall be discussing something that really can improve, like give you momentum in your success as a trader, because you really want to flip small account to a big account so that you can trade with big accounts. Okay, so the topic is how billionaire forex synthetic traders flip accounts to infinity dollars plus. Okay, you see, you can't be a millionaire, you can't be a billionaire if you cannot start from somewhere. So when you are starting from somewhere, most time, because the market is volatile, most time if you try to grow account in a normal way, you discover that at a point you started having losing streaks. It is natural for some traders to have losing stream that can blow the account, because you might not be able to figure out why such thing happen because you are not an expert. So the idea of flipping will now come in order to solve this problem. You really want to flip a small account to a big account, even withdraw some profit and continue normal trading. Like you now trade that big account with proper risk management. When you are flipping, you are not using a conservative or a kind of strict risk management. You are just taking high risk but with sure signals. In other words, the signal have to be sure, and then you use full margin, you use all your equity, you roll over, and then you go full margin. That is flipping. Okay, so we shall discuss, like, to make this thing work so fast, we shall be using season, support, resistance, change of trend, key levels, underlying market structure. So we shall be using these ideas to explain how you can flip. You really need to understand how to do this. Okay, now what is the minimum equity? What are the necessary conditions for flipping to be successful? You need unlimited leverage. Okay, you need unlimited leverage. So check down the description of this video, you will see link to 𝑬𝑗. You sign up with 𝑬𝑗 for forex market, and then sign up for 𝒐𝒕 for synthetic market. These companies, these brokers, give you unlimited leverage. For 𝑬𝑗, you have to select unlimited accounts, because we have normal account and unlimited account. You have to select unlimited account and deposit at least $500 so that you can be able to make use of unlimited leverage in 𝑬𝑗. But for the all you just need to deposit at least $1, $5, $10, and then you're automatically given unlimited leverage. Okay, now another thing you need in order to flip an account, a small account such as $1 to $10 or $1 to $100, is you need the proper knowledge of getting a short signal. Okay, and your entry and exit. One thing is to get a short signal, one thing is to define your entry, and the other one is your exit. Okay, so these are the things I'm going to discuss in this video. So let's go to the MT5 and start working on this. So right here, before you start to flip an account, okay, you must have run a background, like you must have run a kind of asset analysis. You must have analyzed assets in the past. Like you must have the knowledge base, like you must have the knowledge base of few assets that you want to be trading for that period of time. So you should have studied those assets in the past, maybe 2 days ago, 3 days ago. Like you have to study the assets about 2 or 3 or more, in the past, so that when you start the flipping, you will have full understanding of the market structure. So you have to study the market structure, study the price action, for a couple of days, so that when you will start the flipping, you will know the right direction to follow. Okay, what are you studying in the market structure? You are studying the key levels, you are studying the resistance and support, you are studying major and minor trend lines, you are studying internal and external planes, you are studying a lot of things, and you are putting this thing in your knowledge base, so that if you open the asset, you will not be making some mistakes. Yes, you might be buying and this market you want to sell, and you might be selling and this market you want to buy. All this is because your knowledge base is not complete. Your knowledge base is compromised. Okay, so right now I'm going to open volatility 75 index. Okay, now I'll just feel like I've been following this market since 2 days ago, because I'm looking for treasure. I'm looking for I want to understand this market, so that if I start trading, I will not lose. Okay, so let's assume that I've been following this market for a couple of days. Then I need to look on the daily time frame and see what is happening in this market. When I look on the daily time frame, if I cannot get a valid information, you see, start from the top down analysis, start from the monthly. There's nothing like pride in this. You can't just escape the top down analysis. It's very, very important. So what you need, understand what is happening in the month. So the month is selling, and you go to the weekly. The weekly will definitely sell from here. So if you want to flip account, you can use this sell event in the week to flip the account. Okay, so you step down to the daily time frame. Then immediately you see this dodgy cross, you know that sellers have created imbalance in this market. And then you go to the H4, step down to H4 on the next day. What's happened? You see that sell season activated in the 4-hour time frame. Sell season, immediately market break out of this strong support. You see, this is a support. What happened? The sell season has been activated, and you already know where the selling is heading to. It's basically heading to this low. That is the essence of top down analysis. It's heading to that low, right? Cool. Now, as I said, mark the resistance or support that is visible to you as you approach the entry time frames, that is lower time frames. Now let's step let's go to our entry time frame, the 5 minutes or 15 minutes. So I'm in 15 minutes time frame. What do I do? How do I flip these accounts? This is $10 account. Let's assume I have a $10 account. I want to flip $10 account using this season. This is a sell season. This is a bear market, right? I want to flip $10 account using this season, right? I don't want a story. I will look for a very strong resistance because it's a sell season, so you'll be looking for a resistance. I look for a very strong resistance and mark it. I will patiently wait for price to come to it. When price comes to it, what do? I will measure as it is approaching this zone. I'm going to measure the distance from where it is, from the part of this zone closer to price, which is here. I'll go to the part away from price. That will be my stop loss, right? I'm not going to place stop loss because I'm doing flipping, right? But I need to calculate this stop loss pip so that I will use it to find the loss size that I'm gonna use. Now that is the formula for calculating loss size given a stop loss pips, because it is stop loss that determines the loss size. Okay, now if you want know the formula, you have to be my VIP subscriber. You have to get verified, and then in my VIP you'll be able to see the formulas, and then you can deploy it on your private trading. Very important. And so right here you are going to use all the loss size as calculated, because your belief is that market cannot go beyond this zone, and then you are going to close the trade when it gets to a support. And what is the support? That is a support. This is a support because price reversed here to the upside, so it's a support. You are going to take your profit here. When you take your profit, okay, what do? You look for another strong resistance. You look for another strong resistance, not support, resistance, because we are doing what? We are selling. And then I get one here. What do? You measure again, and then you go full margin, calculate the loss side, go full margin. Okay, very, very important. Go full margin. In most cases, you can assume a particular pip. You can assume that once the price have come to your entry price, once you have gotten your entry price, the trader cannot go beyond certain pips. So the lower the pip, the greater the loss size and the bigger the profit. So you can decide to say, okay, you'll be risking 700 pips. Okay, that's cool. And so this is a support. You are going to take your profit. Okay, when you take your profit, you locate another resistance. You see where we have another resistance here. There is a resistance here. So you are going to place a trade here. Okay, and then you are going to measure 800 pips, and then use it to calculate 700 pips, and then use it to calculate your loss size, and then you are going to take your profit here. So this is what you need to know in flipping. You need to know where the market is heading to, and you have to follow that direction. Don't trade against the season. The season is selling, so you have to follow it. I didn't expect this content to take time, but I'm going to end this video. Remember again that we are actually discussing these things in terms of season, support, resistance, change of trend, key levels, underlying market structure. But for all these things to be realistic, we have to run top-down analysis. Very, very important. Direction obeys top-down analysis. The real direction in the market obeys top-down analysis. Okay, so when you look at how the flipping will be like, you have a $10 account, and then as market approaches that resistance, because we are selling, right, you risk 700 pips, which is around here, and then you cut, because you want to take your profit here, so you cut almost 4,000 pips. Okay, now the risk reward is what you need to calculate. Let's go open calculator and get the risk reward. Very important. So we have 4,000 divided by 700. So the risk reward is 5.71. Now if we have 5.71 as risk reward, we are going to have $57 in profit. You see, I'm teaching conservative account flipping method. Okay, but maybe in part 2 of this video I'm going to talk about aggressive flipping method, whereby the stop loss peak is so tiny and you just believe that the stop loss peak is closer to 0, and so you can use, like, you cannot deem it to be okay depending on the asset. You cannot deem it from 50 to 100 pips for volatility asset. Depending on the asset, you know, it can be like very small pip, and then you can still use the formula to calculate the lot size. The formula that I'm telling you about, which I didn't show you in the video, you can use it to calculate the lot size. But one thing, if you are flipping but you don't know the maximum drawdown, you might use a lot size that will wipe your account when the market draw down beyond certain limits. So you have to think about this. But I'm teaching the conservative method. Maybe in part 2 I'll talk about the aggressive method, but I don't need to create part 2 of this video. I've already said it indirectly. Like, for aggressive flipping, you are reducing the stop loss peak to near 0, like numbers that are very close to 0. What are numbers close to 0? 1. Let's say from 1 to 10 is close to 0, from 1 to 20 is close to 0, from 1 to 50 is close to 0. But when you're using bigger number far away from 0, like 100, 50, I'm sorry, 200, 500, 700, depending on that set, you are pretty much going into conservative flipping, because you don't want to lose that money. You really want to make this money. You know, another part of aggressive flipping is when you are adding more position, like when you are investing your profit while you are flipping. It's also aggressive. I'm going to talk about that shortly. So right here we have $57, and now we wait. We close the trade, and then we wait for another resistance. Okay, so we saw this market coming towards here, so it's approaching the resistance. And remember, we talk about trend, so you can see there is a trend line here. Always get every structures of the market, so trend is part of structural analysis. So we have this, so you can enter trade here. You risk your 700 pips. Again, you risk your 700. You can see that price cannot go against you by 700 pips, meaning that once you calculate the loss size, it's going to hit your take profit. So here we have, right now we have $67. Okay, then you calculate the loss size again, but here the risk reward will reflect everything. So we are going to be taking your profit here on a support, right? So this is 3,000, around 3,000, and then you are risking 700. Right here, your risk reward is what? Your risk reward is 3,000 over 700, 4.28 times 67. So we are now up by $286 plus 67. We are now up by $353 plus. Now we look for another entry here. Okay, there is a resistance here, so you look for another entry. You risk 700 pips, and your target, this is a support, 2,500, and so the risk reward is 2,500 divided by 700, 3.56 times 353 plus 353 plus 353. So you have $1,623.8, right, from $10 account. But this is not aggressive. Somebody that is using aggressive method should have made more money. Now this is conservative. Let's go to aggressive. For aggressive method, once you place the first positions, once you reduce your stop loss pip, because you just believe that the drawdown is zero, like the drawdown is minimal, right? So you just enter the trade and maybe you calculate something like 100 pips or 50 pips, you know, or you calculate something like, yeah, this is 𝑽𝑗𝑗𝑚𝒂. So from 100 to 200, this is what you calculated, and then you targeted. You just calculated this and use it to find the loss size. Then once you enter position and the market start going in your direction, you go to what we call a line chart. When you go to line chart, in that time frame of entry, that is where you are going to carry out this process, this idea. So this is your time frame of entry. Then when there is a V and the breakout of V, it means that the market is going to increase in speed. You add more position. It's not retracing. It means that the drawdown will be zero. You add more position using your profit, the profits you have made, and your capital. And then what do you calculate? You calculate. How do you calculate the loss size you are going to use? You measure from where you entered to the other side of that range, which is somewhere here where price can never go again. You measure it, use it to calculate the loss size, then you add those positions. Then when you see another one, actually when you add this position, you are not going to close all the trade here, and then you wait for another resistance like this one. And then when you use this one to place the first trade, then when the market reach here, this V, it break out of this V, then you add more position by using this SLP and considering all your profit and capital, and then like that. You see, this is what we call aggressive. So I don't need to, make it complicated. I'll be ending this video. Thank you, and see, if you have not cashed out for the first time, but each time you trade you lose, each time you deposit you lose, each time you trade you lose, even if you're gonna really want to build on your own, leverage the effort of successful trader, copy and paste our signal in real time. Each time we trade, you trade our signal, we make profit, you make profit, we don't lose. We don't know what is lose, what it means to lose. Nothing like loss here, because the knowledge base is complete. The knowledge, if you don't know about the market, you're gonna lose money. Okay, so thank you and bye for now.
You've got it if you're prepared to break the silence.